Hi, I'm Jonathan Shelon. I'm the Chief Operating Officer at KraneShares, and I'm also the co-portfolio manager of KLIP, our KWEB covered call strategy. Welcome to our webinar. Delighted to be talking to you today and really addressing some of the market volatility we've seen that's affected not just traditional ways of investing, but also covered call strategies. And if you invest in covered call ETFs, you're probably experiencing something this year that you may have never experienced in these strategies before, particularly if you hadn't invested in them since 2022 or before. You lost money, and not just a little, but a lot. Major US covered call strategies focused on the S&P and NASDAQ had drawn down by about 15 to 20%. And single stock covered call strategies were down as much as 50%, losing much more. So what does somebody do? Do you abandon covered call strategies in this environment? Of course not. So today we're going to discuss how to build a more resilient covered call portfolio and why the KLIP ETF can play an important role. But first, I wanted to offer up some housekeeping items. We are offering one CMA and one CFP credit for your attendance. So if you want to receive that credit, please email ce@KraneShares.com with your details. And just note that we are live streaming this webinar on our website and also on Zoom. We want this to be a lively discussion, so please email your questions to info@KraneShares.com. And if you're streaming from our site, you got to use the Q&A button at the bottom of your screen if you're in Zoom. So just to be clear, if you're streaming on our site, email to info@KraneShares.com. And if you're on the Zoom, there's a Q&A button at the bottom and you can submit your questions there. Before we get started, I also wanted to acknowledge the brilliant Robin Zhang. She provided enormous quantitative firepower to our materials, and also a hat tip to the unflappable Henry Green, who delivered crucial perspectives throughout our materials. So for those of you that aren't familiar with KraneShares, a couple of things to know. We manage about $9 billion in assets in 34 funds around the globe, and we've been managing money since 2013. We're the first firm to focus on China thematically with our flagship strategy, KWEB, which was launched in 2013. And we offer unique access into China, into climate, as well as alternative categories. And because our offerings are so unique, we place client service and engagement as our #1 priority. And that includes constant communication. So if you want to receive real-time updates, near real-time updates on China, I recommend that you visit our daily blog. It's called China Last Night, and you can go there through the QR code on your screen or by visiting ChinaLastNight.com and signing up. This is penned by our CIO, Brendan Hearn, and it is a phenomenal resource to all. Next slide, please. So this is just an expanded view of our suite, and you could see that, as discussed, we have a significant amount of options in the China space, and KWEB is top on this list. It's our China Internet and E-commerce ETF. It holds about 30 names like Alibaba and Tencent and Pinduoduo and JD. But it's not the only way to access China at KraneShares. You can also have exposure to themes like healthcare and clean tech and the Starboard and so on. But it's important to note in these environments that many of our other strategies, particularly in the climate space or in alts, are very important in these markets and have done quite well this year in contrast with what we're seeing in traditional US equities. If we zoom in on the next slide, we can go a little bit deeper and talk about other ways to have exposure, kind of thematic exposure in things like China, as we talked about with KWEB. But if China is too narrow for you or your clients. We also have KMQ, which broadens out the internet theme across emerging markets. If you look on the far right, you can ramp risk up by actually having levered exposure to some of the top names that are within KWEB, with KBAB, which is 2x Alibaba, and KPDD, which is 2x Pinduoduo. So that's a levered way of getting exposure. And then right in the middle of the slide, we have what we call our China Volatility Management Suite. We'll talk about what made this possible, but the bottom line is that KWEB has a phenomenally deep and rich options market, and that's allowed us to combine KWEB with options to produce different types of outcomes depending on your needs. And that could include covered calls, as we have with KLIP, or strategies like KPRO and KBuff that offer buffers on China internet exposure. So I wanted to highlight that before we get going here, just so that you know we have a full suite of China strategies, alternative strategies, but also within China, different ways of achieving your desired returns. Let's jump to the next slide, please. Now, if you've been through market cycles, many of them like I have, you may have been perplexed by what's been happening over this last decade. Anti-diversification was the key to success. Who needs global equity portfolios when you've got the S&P? And who needs the S&P if you have NASDAQ? And on second thought, scratch that. I don't need the NASDAQ. I've got the Mag 7. Investing is easy. Everything is awesome. Now, is that sustainable? Not really. And so market traditionalists like me have really had their faith restored as Trump has made diversification great again. International markets are rocketing. Gold is way up, the dollar is dropping, the 10-year yields are spiking, and risk matters once again. In this environment, our flagship ETF, KWEB, is up 20%. Non-US markets, so this is developed and emerging market outside of US, is up about 12%. And US markets, as measured by the S&P and NASDAQ, are pretty much flat this year. Now, given some of the recent performance this week in US markets, one might think, okay, well, that was a blip. But I would caution against thinking that this is a temporary state of affairs, as changes like this one can be secular in nature and last a full market cycle and beyond. In fact, if you look at prior cycles, they sometimes last 10 to 12 years. And we do believe as a firm that the next 10 years will look very different than the last. So at this point, let's switch gears a little bit away from kind of macro and big picture and get into the subject at hand, covered call strategies. You could see that this derivative income space has grown tremendously in the last 10 years, surprisingly so. In fact, the last 4 years have really gone parabolic. And this derivative income space is primarily driven by covered calls. There are now over 100 covered call strategies in the US market, and they represent over 100 billion in assets. So to say that they're popular is an understatement, and it makes sense why. Ever since 2022, when rates started to rise and we started seeing equity drawdowns, investors were seeking ways to dampen risk while generating meaningful monthly distributions. And so we think that it's important to understand kind of the nature of this derivative income and covered call space, and also think about how to properly structure a portfolio. On the next slide, we're going to peel back the onion, and we're going to categorize the covered call space into a few different segments. The largest, not surprisingly, is the US covered call space. So all of the real large mainstream ETFs are in here. These are the ones that track the S&P and the NASDAQ, and they represent a large portion of this 88 billion in assets. So even though it shows 59 funds, there are 5 funds that dominate the space and represent the majority of assets. Now, as a group, and this group also includes ETFs that, while in the US, may be more concentrated and focus on sectors, as a group, they represent about, over the last 12 months, of about 20%. And you could see this year down about 6% in terms of returns, with a standard deviation of 34%. Now, if you go one level down, you could see that there's also a single stock trend. There are now 39 ETFs that do covered calls on single US stocks. And this area is growing as well. And you can see that this represents about 10% of the covered call universe. They pay out much higher distribution rates, but have much more risk, with volatility more than 2x the levels in the broader US space. And then there's the international covered call space. There are only 3 ETFs that we identified in this category, but they're growing. It represents about $500 million now, 12-month distribution rates of 24%, and similar levels of volatility. But the big distinction here is that the international covered calls as a group have positive returns this year, while the US versions in total, whether the broad-based or the single stock, are both down. And our variation of international covered calls is KLIP. And this is taking KWEB and overlaying a covered call strategy on top. So we're selling call options, and then we're paying out a portion of that each month. You can see that over the last 12 months, we've distributed 43%. The fund is up 2% this year and has volatility somewhere in the 30% range. So I think this is important, right? Not all covered call strategies are built the same way. They don't all behave the same way. And that actually creates opportunities. And why is that? Let's jump to the next slide. One of the reasons is correlation. We all know, and again, this really hasn't worked in the last decade. So, I say it tongue in cheek, but we think it's important, really important to consider now. If you look at correlation, you'll find that, between the S&P, the Russell 2000, and the NASDAQ, it's in the 0.9 to 1 range, meaning correlations are very high, which means that things tend to move up and down in a fairly consistent fashion. If you look at correlations between US equities and the rest of the world, you see that the correlations drop to something like 0.7 to 0.8, which is good because you're smoothing out the cycle, if you will. You're smoothing out the risk. And then if you look at correlation with respect to something like China Internet, which is really quite different than broad-based international investing, you'll see that the correlations drop way down somewhere between 0.4 and 0.6. Now, the reason I show this, and you might say, well, what does this have to do with covered call strategies? The correlation between the broad markets and the covered call strategies are reflective. In other words, if you were to use an international covered call strategy, you would improve diversification. And if you use a China-based covered call strategy, you further improve diversification because their cycles are quite different. So this correlation matrix does correspond and translates to the way you should think about building a covered call portfolio. Next slide, please. So we've done a little bit of that work. We've dusted off the old efficient frontiers. Now that diversification might be working again. And it's really interesting what happens. You'll find that if you blend a combination of US and international covered calls, you can enhance your distribution rate because international covered calls tend to pay out more. And you can also reduce your risk because of that correlation benefit that we spoke of. Now, mind you, your individual situation is going to depend based on which particular covered call strategy you utilize. So the point on this chart where you may be with your US covered call strategy might be different. And the point where your international covered call strategy is might be different depending on what you use. But the shape of that curve, that curvature, that ability to reduce risk and increase distribution rates should remain pretty robust. So again, the starting point and the ending point may be the same or maybe different rather, but that curvature that allows you to reduce risk, we believe should remain intact because of that low correlation. Next slide, please. So now that you understand the benefits of blending international covered calls with US covered calls, let's talk a little bit about KLIP. So this is our KWEB covered call strategy. It focuses on China Internet as a theme, and it has some pretty unique features. First and foremost, it's a straightforward strategy. There's nothing particularly complicated that we're doing. It's very much akin to what you experience with other covered call strategies that you may be using. And in fact, our version might even be simpler, because what we do is we simply buy KWEB, and then we write covered calls directly on KWEB using KWEB options. So very simple. And if you look at the holdings of KLIP, you'll see just that. You'll see a line item for KWEB, which is our China Internet ETF, and then you'll see a series of call options that we tend to write about weekly. The calls tend to have a maturity of 30 to 35 days, which allows us to pay out a portion of that, around 2%. Next slide, please. And what makes KLIP possible is the really deep options market that has been created around KWEB. You'll find that it has the second largest options market among all China ETFs, with a notional amount of right around 7 billion. It's also the 14th largest options market amongst all the US listed ETFs, all 4,000 plus of them. So it's a very liquid options market, and it allows us to efficiently execute strategies like KLIP and provide what we think is meaningful value. Next slide. So here's just another recap of how it works. If you think about KWEB, when you buy KWEB on its own, you're getting uncertain downside and uncertain upside. And when we build KLIP, you're getting uncertain upside and uncertain downside, but we're writing a call. So we're substituting that uncertain upside for a premium. And what that leaves us with is option income plus uncertain downside. What that means is that not just KLIP, but all covered call strategies really behave like this. And that's why in periods of drawdown like we've had this year, people have been surprised that there's downside in their covered call strategies. But again, it shouldn't be surprising, because this is effectively how they work. Next slide, please. But here's where we get into some of the mechanics. This chart represents the volatility, the realized volatility of different indexes and KWEB. And you could see that for the S&P and the Russell 2000, which is the small caps, and the NASDAQ 100, the volatility tends to be very much aligned. In other words, volatility spikes around the same times, and you could see that happen here in early 2020, and that was through COVID, and then it also declines, and then it ebbs and flows in a very similar fashion. And that makes sense, because we all know that in the US markets, if the US large caps decline, the small caps tend to decline. So the correlation within the US markets, as we pointed out, is very high. This is not a mystery. But what's interesting is KWEB's volatility has a life of its own. It follows a different cycle, whether it's an economic cycle, a news cycle, and so on. So you could see that spikes in KWEB volatility will occur at different points in time than spikes in US markets. The other thing that's really important to note here is that the volatility of KWEB is systematically higher, almost without fail, than the volatility of major US indexes. So more option income equates to more distributed potential. And on the next slide, let's get into that a little bit. So on the left-hand side, we rank the implied volatility within the options market for the S&P, the NASDAQ, the Russell 2000, and KWEB. And you could see that much like the prior chart indicated, the implied volatility in the options market is much higher for KWEB, about 2x what you experience in the S&P, and almost 2x as high as what you experience in the NASDAQ and the Russell 2000. And the relationship between implied volatility and the amount of option income that you create every month is almost linear. And that's what the chart on the right-hand side shows. It shows that if you're writing options on the S&P, your monthly option income is 2.2%, at least as of this date. And if you're writing options on KWEB, because of the higher implied volatility, you're generating is 4.6%. And our experience has been historically somewhere in that kind of 3 to 5% range. In fact, I could tell you that because volatility was higher in the month of April, our average option income in the month of April in KLIP was actually 6%. So these numbers do ebb and flow. That's important. It's going to be based on the volatility that you saw before. But it's really powerful to think of. And this is quite frankly why some of the single stock covered call strategies have become quite popular, because they push this way out the curve and generate very high option premium, but at the cost of very high risk. Next slide, please. And you could see here that we began KLIP we launched it back in 2023, but if we look back over the last year, you could see that our monthly distributions were somewhere in that 3.5% to 5% range, because at that time, prior to this year, we were paying out exactly what we earned. In other words, if we earned 3.5% in option income, that was what we distributed. And then earlier this year, we capped our distributions at 2%. And we did that because a lot of our clients were coming to us and saying, you know, I really appreciate the high levels of distributions, but every time you pay out a distribution, the NAV goes down by that amount. And because you're writing at the money call options, it's not assured that we would get that back in appreciation. So now what we've done is we've capped our distribution rates. They are capped at roughly half the level of what we earn in option income. And that allows for greater appreciation potential in the NAV. I think a lot of our clients have been very pleased by the results, especially this year. Next slide, please. So if you think about the kind of history of the markets, and if you think about, you know, what we've experienced in the US markets, we've had phenomenal success, right? In 2024, the S&P and the NASDAQ were both up 25%-ish, significant. And the covered call strategies written on those types of markets were also up quite a bit. And this year, with the S&P and the NASDAQ down, the covered call strategies that represent those markets are down as well. You could see, however, historically, KWEB, our flagship fund, was up meaningfully, you know, last year and even year to date this year. This is as of 4/30. I should mention that KWEB's up almost 20% now on a full year to date basis. But if you think about the performance that we've seen with KWEB, it's underperformed US markets. And quite frankly, over the last several years, there's been this divergence in returns because of this phenomena where diversification didn't matter. And so it turns out that if you look going forward, KWEB has PE ratios and valuations and earnings potential that exceeds many of the other opportunities around the globe. And this is highlighted really on the slide on the right-hand side, where KWEB PEs are kind of in the 15% range or 15 multiple range, whereas S&P PEs and NASDAQ PEs are much higher, even following these drawdowns. And going a step further, if you want to take earnings growth into account, You can look at something like a PEG ratio. A PEG ratio just takes PE and divides it by growth. So if you have a PE of 20 and growth of 20, the PEG ratio is 1. And obviously, if you have a PE of 10 and growth of 20, the PEG ratio is 0.5. So in industry parlance, PEG ratios below 1 are really quite attractive. And KWEB as a whole has PEG ratios that are below 1 right now, whereas PEG ratios for the S&P and NASDAQ are much higher, 1.6 to 1.8. So there are ways that you can think of this resolving. One is that the KWEB valuations increase, so you have multiple expansion, and or the S&P and NASDAQ valuations contract. Or it could be some combination of the two. But my point would be, you definitely want to have a combination of things right now in your portfolio, and that applies similarly to China Internet and US equities, or China Internet as complementing your covered call positions. So just to wrap up on the next slide, we've seen some real meaningful progress. And what I think would come as a surprise to many is that despite the fact that there was a big announcement a couple of days ago between the US and China on tariffs and trade, which was very positive and well received by markets, China had done quite well before that time. In other words, because China was so undervalued and underloved and underowned, China was already rallying this year. And this announcement has given further foundational support to China, but it's also given a lot of support to the US. Volatility in the US has come down, and US markets have resumed their climb. So it just indicates the importance of this US-China relationship economically and fundamentally. And as I've mentioned many times before here, KWEB's done spectacularly well this year. It's not to say it's not risky. It is risky. And that heightened risk is what allows us to produce a covered call strategy with very attractive option income capabilities, with option premium that are roughly 2x the level of what you see in other traditional covered call strategies. And we do think, because Trump has made diversification great again, it's really important to relook at international diversification across portfolios. And I know we focused here on international diversification, but the truth is this is something that someone should be looking at across asset classes. So whether it's in stocks or bonds or alternatives, and certainly KraneShares has great options, pardon the pun, for you to utilize across your entire strategy. So, my closing remarks here are, please relook at how you're building portfolios. Think about international diversification, and don't stop at just international diversification at traditional stock exposure. Consider diversifying your portfolio within strategies like covered calls as you're using more and more of that type of approach. At this time, we're going to move forward and shift over to the Q&A segment of our discussion. So with that, let's get into some of the questions from the audience. Okay, and I do see a question here, and yes, so we will have a replay available of the materials here today, and we'll also have access to the presentation. And just as a reminder, if you have logged in here by streaming through our website, please send your questions to info@KraneShares.com. And if you're joining us via Zoom, please just place your question right in the box. Great. And so here's another really I think, thoughtful question. Somebody asked, if we earn 6% in option income in April, why are we only distributing 2%? And we've given this a lot of thought. I touched on it briefly, but what we found is that if we pay out everything that we earn, so if we earn 6%, we pay out 6%, that's very high. But remember, if there's any drawdown period, or if there's any negative performance in KWEB, that has to be absorbed by the ETF as well. So it creates this concept of NAV erosion. So you may actually see a declining NAV over time because we're paying out everything we make and we're not leaving anything as a cushion against those drawdowns. In contrast, if we cap our distributions at 2%, which we think is still a very attractive level, right? That's 24% a year. It gives us a chance of keeping the NAV more stable. And that's exactly what we've seen this year. We've seen that most of our returns in KLIP have aligned very closely with the amount that we've distributed. And that's what we'd like to do. We'd like to target a total return in the strategy that aligns with what we're paying out each and every month. And our clients have been quite receptive to this. You can almost think about it as reinvesting a portion of the option income directly into the fund. There's another good question here about how we assess political risks in China. And it really is an interesting one because, as you know, there's a lot of geopolitical tension between the US and China. I think some of it is because the US is the largest economy in the world, the largest stock market in the world, and the largest bond market in the world. Whereas China is the second largest economy in the world, the second largest stock market in the world, and the second largest bond market in the world. So you have effectively a rivalry because you have two great nations, large economies, deep capital markets. And I think you're going to have some of that natural tension that goes along with that territory. However, what's forgotten is that the size of the economic relationship is massive. There's a lot of talk about the trade deficit, and the trade deficit is only a few $100 million, right? We buy about 600 and something billion dollars worth of, and I apologize, I should have said billion, not million. So we buy about 600 something billion dollars worth of goods from China. China buys a couple $100 billion worth of goods from us. And because they buy less than we buy, there's a deficit. But that's not the whole story. It's important to also remind people that US companies make a lot of their revenue from China that doesn't get reflected in those trade numbers. Based on estimates that I've seen, roughly 7% of S&P 500 revenue, or $1.2 trillion, is earned by US companies doing business in China. So think about Starbucks, Apple, GM, Tesla, on and on. So the size of the relationship between the US and China extends far beyond trade. It extends directly into the revenues of Fortune 500, S&P 500 US companies and their profits. And that's why I think you've seen a very interesting, and I think to some a very surprising announcement that with what you heard from Scott Bessent and others on the China side. It was very balanced. I found it warm. Nobody was trying to make the other appear as a loser. And I think that's because the economics will trump politics in this instance. So I'm very optimistic about what happens next. Again, there's always uncertainty, but having both sides drop tariffs that were between 125 and 145% down to a more reasonable 10% over this cooling off 90-day period is a great start, and I think very much indicative of more good news to come. Let me talk briefly about how people use KLIP in their portfolios. one of the early adopters of KLIP were actually investors in KWEB. And that's because, KWEB is a way of getting pure exposure to China internet and the ability to really capitalize on moves like those that we've seen this year, but it does come with risk. And maybe we can put up the slide that shows the historical performance of KLIP and KWEB since we launched it. I think that could be instructive here. There it was. Okay. So if you look at the history of KLIP since we launched it back in 2023 and compare it to KWEB, you could see that KLIP has produced meaningful outperformance over this period of time, with about half the volatility and half the drawdowns. So truth in advertising, right? KLIP is a strategy that generates option income each month, which cushions the downside. But I want to be very clear, this has been a particularly challenging period of time for KWEB. As we discussed, if you take many factors into account, whether it's the strength of the Chinese economy, some of the geopolitics and so forth and so on, the returns for KWEB over this period of time were pretty much close to flat with quite a bit of drawdown risk. So in that environment, KLIP has done very well. And all that is to say, many investors that buy KLIP are looking in some way to customize their risk exposure with KWEB. So if you're looking for, let's say, 1% a month in distribution rates, you can blend 50-50 KLIP and KWEB and achieve that outcome. That also allows you to reduce some of the volatility and some of the drawdown risk in KWEB. So those were the early adopters of KLIP. And now what we're seeing is something that, we talked about on this webinar. Investors are starting to blend KLIP with US-based covered call strategies. I think this is an emerging trend. I think it's going to accelerate. I actually believe that international covered call space could grow significantly in the coming years as people realize that this is a way of creating more durability in their portfolios. There's a question about the reinvestment of dividends in a covered call strategy like KLIP, and how important is it? So my view is, if you want to achieve, if you're looking to achieve the total returns that KLIP is going to provide over time, you have to do that by reinvesting. However, we recognize, and that may be appropriate in a traditional portfolio, a portfolio where you're running a 60-40, so you have a basket of stocks and bonds and alternatives and cash and so on. So if you have a total return objective, having reinvesting your KLIP distributions, I think, is important. However, if you have a different objective, if your portfolio objective is to create distribution rates or achieve certain distribution rates every month, then you don't have to reinvest the dividends. You can take those and you could spend them. But again, that's what's, that's kind of the first question you have to ask. What's the objective of the portfolio that I'm putting KLIP into? And if it's a total return objective, I would reinvest. And if it's an income-oriented objective, I would absolutely, not invest, because my client needs that to spend. Just going through here. So there's a question here about the distribution rate. Somebody's asking about the 42% distribution rate. And I think we did share on screen that over the last 12 months, KLIP did pay out a distribution rate of 42%, but you shouldn't think about that as the prospective rate, because we did change our policy for KLIP distributions to cap them at 2% a month. The forward-looking distribution rate would be more akin to that 24% level. And I should note that capping mechanism is common in industry standard. The flagship ETFs that are out there, many of them will cap distributions at 1% a month, so about half of our level. So again, this goes to Not all covered call strategies are created in the same way, and understanding these details, I think, are super important as you journey into these strategies. There's another question about how you evaluate these strategies, looking at different public sources like Yahoo Finance or CNBC. And I think the challenge is that when you look at a public news source like that, and I use, by the way, CNBC on my phone as an app, and I've certainly looked at Yahoo Finance and so on, but they all consider price return. And price return is just saying, okay, the price of this security was $50, last year, and now it's $75. And so it has a price return of 50%. The challenge is that if there's a distribution that was made at any point in time in that 1 year period, it's ignored. And so if you had a 10% dividend or a 10% distribution, it doesn't get picked up in that math. And so what that means is that for covered call strategies, which are heavy, that are distributing each and every month, when you look at the price return, it could be extremely misleading, and it could meaningfully underrepresent the return that you would have earned had you invested in that strategy, particularly when that strategy has high monthly distributions, 2, 3, 4, 5%. And so I caution anybody who's listening to not rely solely on public sources that just show you price returns, and really focus on source data from, say, the website. So this is an example here of the growth of 10,000 on our website, and you could look at different periods. So, for example, click on the year to date. So this is the KLIP performance year to date. You could see it's up about 6% now. And again, that's what we're really trying to accomplish, achieving returns that are similar to what we're distributing. Again, it's not a perfectly smooth ride. There are periods of ups and downs, but really this is the best way to understand what the return of a covered call strategy is, unless, of course, you have more sophisticated tools like Morningstar or FactSet or Bloomberg and so on. But if you wanted public ways of viewing performance, I would very much strongly urge you to visit our website or others' websites to understand total returns. And of course, we print that in all of our materials, our presentations, our fact sheets, and so on. So you could very much access the right way of looking at returns directly on our website and in our materials. There's a question here about there are a couple questions that I want to get into. One is on fees. So in our case, the way fees work is we invest in KWEB. So there's a fee embedded in KWEB that is priced into the ETF. And then we charge a 25 basis point management fee, so 0.25% for implementing this covered call strategy. We think that is a very competitive price for the work that we do and the systematic management of the calls and the distributions. But I leave that to you to determine how that compares to other things you may be investing in. We see it as very cost effective, particularly given the unique access that we provide. There's also a question on, why do international covered calls distribute more? And I think it's exactly for the reasons that we talked about with our own example, KLIP. They pay more because they generate more option income, because the volatility of the markets they operate in is higher. So, if we go back, let's pull up that slide that shows the linear relationship between option income and volatility. It might be good just to kind of emphasize that point and talk about where different strategies may lie. So let's go to, sorry, not here. Let's go to the slide that shows the implied volatility for the S&P, NASDAQ, and others. Very good, perfect. So, kind of going back to this, S&P, less volatile, lower monthly income, 2.2%. China internet, more volatile, twice as volatile, twice the option income. And so what you would expect is that a lot of the broad-based international strategies should generate option income that's somewhere between the NASDAQ and KWEB and KLIP rather. So that is fairly intuitive, and that's how I would actually go upon building and allocating these to these strategies. You know, find what your target income level is, identify the amount of risk that you're able and willing to take, and then do a blend, just like you would with other funds. Okay, so there's a question here about plans in UCITS. So UCITS and is part of the international offering that we have. So ETFs that are listed, say, on the London Stock Exchange are called UCITS strategies. And we are actually studying the ability to generate an ETF like KLIP in the UCITS space. We don't have it yet. We do have KWEB listed on the London Stock Exchange for anybody who's listening from overseas. So that's available. And we do want to leverage the kinds of capabilities that we have here with KLIP also overseas. We're studying and actively thinking about that, but I don't have an ETA quite yet for you. But please reach out to us and we'll make sure that you're well updated on that. And then there's a good question here about, you know, we showed a couple of different things. We talked about volatility and implied volatility, and now we're getting into kind of a more technical conversation. But let's go to the slide, please, that shows the historical volatility of the different indexes over time. So one before this one. So this is what's called realized volatility. And this is just calculating the standard deviation of the returns of KWEB and S&P and NASDAQ and others over time. So this is looking backwards, and you could see that on the vertical axis, we list this as 1 year rolling volatility. So we're looking at this over, you know, a 1 year period, doing the math and telling you what the number results in. So it's a historical looking calculation. That's realized volatility. Implied volatility is a little bit different. It's on the next slide. While they're similar in nature, implied volatility isn't looking backwards. It's actually looking at the options market, and it's applying a well-known formula developed by Black-Scholes. It's called the Black-Scholes pricing model. And it says if we were to try to price this option for the S&P or the NASDAQ or even KWEB using that options pricing formula, what would the volatility have to be to match that price? And so, as you can imagine, call options are more expensive when volatility is high. So if the observed price in the market is high, all other things being equal, the implied volatility is going to be high. So this is a way of working backwards from an observed market price, which is the call option price that you see. And you know what interest rates are, which is a key input. You know what the time horizon is, which is a key input. The thing you don't know is what the volatility is, so you back into it. And that's called implied volatility. And that's what also gives KLIP an option advantage over some of the US-based strategy because the implied volatility is higher. But like I said, it's a technical matter, but there is certainly a relationship between what you see historically and what you see implied, and you should expect that. So I feel like we've covered considerable ground with Q&A, and I'm delighted for your engagement and interest. It looks like people are really focused on this and thinking heavily about the best way to think about covered calls in the market, especially with all this volatility. And I wanted to certainly thank you for your time and your energy and your focus. And please do reach out to us Whether you have coverage by somebody at KraneShares, please reach out to them for questions, or feel free to reach out to info@KraneShares.com. We look forward to further engagement on this, and excited to have you as a partner. Thank you.